Let's review the data and the news for this week. First on the data, core data that came out this week include December S&P Global Services PMI, ISM Non-Manufacturing PMI, JOLTS job openings, initial jobless claims, and unemployment rate. Now let's look at the key data one by one. First of all, S&P Global Services PMI data came out for the month of December. This data is based on surveys of over 400 company executives, which acts as a prevailing indicator of the direction of the services sector economy. Similar to Chicago PMI and ISM data, an index of above 50 means that the economy is still performing well, while an index below 50 indicates that the economy is weak. Now, if you look at this data, Global Services PMI was at 56.8, which is lower than the forecast of 58.5 and in line compared to the previous month. One thing to note here is that since February 2023, so for almost 2 years, this number has been showing an index of above 50, which indicates that based on the surveys, the US economy is still performing well. Although it was lower than the forecast of 58.5, it is still well over 55, which indicates positive sentiment in the sectors. So this metric tells us a different direction than the Chicago PMI, which we reviewed last week. While the PMI in the Chicago region was well below 50, indicating a weak economy ahead, the US Services PMI is still above 50. One thing we need to be careful here is that the services sectors are generally highly correlated with wages. Now, the reason this index can maintain an above 50 level is because the consumers are still spending a lot of money on personal services, computing, IT, hotels, and restaurants, which would hold the related wages at high levels, which would result in a stickier inflation down the road. If this index continues to show a high level, the inflation may remain higher for a longer period of time, which is bad for the stock market. The second data that came out is the December ISM Non-Manufacturing PMI data. Now, you'll remember that the ISM Manufacturing PMI data came out last week, which was at 49.3, indicating a weak trend as it was lower than 50. However, similar to the Global Services PMI, ISM Non-Manufacturing PMI was high at 54.1, which was higher than the forecast of 53.5, and also higher than the previous month, which was at 52.1. Now, this metric is also a measurement of the services sector in the United States, and therefore, a higher index would mean that the consumers in the US still have the strong consumption power. Similar to the Global Services PMI, this index being above 50 is an indication that the inflation may stay higher for longer, which also means that the interest rate cut may be slowed further. The third data that came out was the JOLTS job openings data. Now, this data is a survey conducted by the US Labor Bureau to measure job vacancies. A higher number than the forecast indicates that there are more job openings, which means that the economy is strong, indicating that the inflation may be held higher for longer. If you look at the data for December, JOLTS job openings stood at 8.1 million, which was much higher than the forecast of 7.7 million. And also higher than last month, which was at 7.8 million. Now, this is also very worrisome, given it indicates that the job market is doing very well, which means that the inflation may continue to stay higher for longer. We observe the same sentiment in the weekly initial jobless data every week, as the data indicated that the initial jobless claims were less than expected for many consecutive months. Now, let's look at this week's initial jobless claims. The initial jobless claims data didn't disappoint us again. With a lower than forecast number, it was at 201,000, which was lower than the forecast of 214,000, and also lower than the previous week of 211,000. Now, as I repeat from last week, this also indicates that the job market is still strong versus the expectations, given there are less people losing jobs. Therefore, this will potentially continue to act as a burden for the Federal Reserve to lower the interest faster. As I mentioned, for the last couple of weeks, people losing more jobs will indicate that the economy is doing bad. And with the economy doing bad, the Federal Reserve would have more means to lower the interest rate to boost the economy. However, as of today, that is not the case. Another data that came out is the December unemployment rate. The unemployment rate was at 4.1%, which was lower versus the expectations and last month as well. This also means that the job market is still doing very well, which may prevent the Fed from lowering the interest rate faster. So with all that, the S&P and NASDAQ were both down again throughout the week, with S&P down by about 0.71%. And NASDAQ also down by about 0.62%. We had multiple straight weeks of downfall in the market, and this week the market was down again, led by the falls of growth stocks like Nvidia. There's been some rebounds within the week, but a slight rebound during the falling trend is quite natural considering the psychology psychology of the overall market. Given the data that came out throughout the week, the market is still reflecting concerns on the sticky inflation as well as aggravated concerns on the strong non-manufacturing data, which will continue to pressure the direction of the Federal Reserve. I just don't get why there's still a lot of people betting the hell out of growth stocks when things are so obvious that the inflation will stay for a longer time frame. Now let's put that all together and see where we are. Let's look at the Federal Reserve table. Taking into account of what happened this week, number one, Global Services PMI data was strong, which means that the interest rate cut will be slowed. Number two, ISM Non-Manufacturing PMI data was strong, which means that the interest rate cut will be slowed. Number three, JOLTS job openings data was strong, which means that the interest rate cut will be slowed. Number four, initial jobless claims were weak, which means that the interest rate cut will be slowed. Number five, unemployment rate was lower versus the expectations, which means that the interest rate cut will be slowed. So taking all that into account, my thesis still holds that the Federal Reserve policy is gradually shifting towards Section D. Now, when I say shifting towards Section D, I don't mean that the Fed will increase the interest rate, but if the Fed cuts the rates slower than the pace of market's expectations, that is considered a shift towards Section D, and all of you watching should be aware of that. I've also been saying that we should think about slowly shifting from growth stocks to defensive stocks like pharmaceuticals and financial institutions. I think based on the trend that we're seeing right now, that still holds to be the case. With all that, I'll end the market update. I'll be back with another market update next week.